The stock market just hit an all-time high, while a war is happening again, while oil is being blockaded again, while your energy bills are going positively nuclear and consumer confidence has collapsed, and while most of the Western world is quietly, politely losing its mind, what are the people who own stocks doing? They're absolutely fine. This is not a coincidence. Now, what if I told you that the biggest wealth transfer in modern history is happening right now in plain sight, and it's dressed up as good news? The S&P 500, they'll tell you, is up 29% in 12 months. NVIDIA has already doubled its profits year on year. Samsung, up massively. The Magnificent Seven, just 7 companies, are on track to make $500 billion in profit this year. Yes, $500 billion. Now, and yet, most people watching this can't afford their grocery bill without checking their bank's balance first, at least twice. The market isn't broken. That's what they won't tell you. It's working perfectly fine, just not for you. So, hello my financially disobedient, quietly panicking, curious market participant friends. I'm not a random bloke on the internet. Well, I am, but I'm a specific kind of random bloke. A bloke who spent years working in the city of London. You know, that great place that we all love and adore. The square mile where the suits live and the rest of us really don't. I interned at investment banks. I spent 20 years watching financial markets do strange, maddening, and occasionally criminal things, and then watching everyone act as though it was completely normal. So when I tell you what's happening right now is genuinely one of the most important financial moments of the past 2 decades, I really mean it. And I'm not just doing it for the algorithm. I'm doing it because someone needs to say the quiet part out loud, slowly, and in a language that is not purposely designed to confuse you. Right, so here's what we're going to call this experiment today: the Profit Paradox Protocol. There's 5 steps, more like 5 revelations, and at the end, you'll understand exactly why this market keeps going up, and why it probably will continue, while everything else feels like it's going sideways. We're going to talk about stocks, how they rise, why they rise, the Magnificent Seven, why AI is either the greatest trade of a lifetime, or indeed the greatest illusion. So, let's stay around for at least step 5, because that's the one they really don't want you to learn about, and the one they really don't want to reach you. So let's start with the obvious question. Why is the stock market going up? There is literally a military stalemate between the United States and Iran. Oil is being blockaded. Inflation is back above 3%. I don't care what the metrics tell you. The real inflation figure is way higher. Gas prices, they're soaring. Consumer confidence, that's, fancy economist language for how people feel about money, well, that's in the basement. Nothing fancy about that, nothing verbose. But the S&P just hit an all-time high. How? How is that even possible? Is it broken? Did someone leave the machine running? No. Here is the cold, the beautiful, terrifying truth. The stock market is not a measure how people are doing. It is a measure how corporations are doing. And corporations, specifically the really big ones, are doing spectacularly well right now. I mean spectacularly well. Alphabet, the parent company of Google, on track to make over $120 billion in profit this year. 120 billion. That's not revenue, that's profit. After all the expenses, after paying all the people who work for them, after paying their taxes, hopefully, 120 billion in earnings, in profit. Meta's earnings rose 61%. over year. NVIDIA, the chip company that basically runs the AI revolution and your sure demise, has nearly doubled its profits from last year. And close to 80% of the S&P 500 companies have beaten their earning expectations. 80% of them. They're literally all printing money at whose expense? Yours truly and mine truly. Now, the market isn't disconnected from reality. It's connected to a different type of reality altogether. A reality where 7 companies make £500 billion, more in dollars obviously, and the rest of us argue about whether we can afford a holiday or whether or not to heat the house or to put food on the grocery table. And yet, here's where it gets genuinely interesting. The average profit margin for S&P 500 companies is now at its highest point in 15 years. 15 years. Now, can you calculate how your life has improved over the last 15 years? Has it gone forward or has it gone backwards? Well, why? There are 3 reasons they admit to. 1, inflation gave companies pricing power. You know, when your favorite brand suddenly says, screw your loyalty, we're going to raise prices on you 50%. And then they blame supply chains. That wasn't entirely the supply chain there, was it? Let's be honest. They could also argue market consolidation. Fewer big players means less competition, which means they can charge more, which means it doesn't really matter what they charge because you are a captured consumer. They own you. And one reason they don't say these things out loud is because the system is designed to reward capital over labor. It always has been. It always will be until the collective decide that it shouldn't. But hey, capitalism seems to be the best system we have out of a bad bunch. Now, the Magnificent 7, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla, 7 companies in a country of 330 million people, in a world of billions of people, generating more than $500 billion in combined profit this year. Between them. Magnificent. Genuinely magnificent. But here's what no one in the mainstream financial press, in their headlines, are actually talking about. They're not talking about the concentration risk. What do I mean by that? Well, the S&P 500 has, obviously, 500 companies inside of it. The top 7 now represent a disproportionate share of the entire market. So when people say the market is up, what they really mean is that those 7 companies are up bigly. For example, Nike reported that revenues are expected to drop. The stock fell 15% in a day. Software as a service or SaaS companies are being sold off because AI is probably going to eat their lunch. This is not universal prosperity. This is highly concentrated wealth in a few hands. Right. The AI question. Is it real or is it a bubble? Honest answer. Yes. Both, simultaneously, all at the same time, like Schrodinger's bubble, Schrodinger's cat. It is both transformative, we can all attest to that, and potentially the most overhyped investment narrative since someone looked at a stock website in 1999 and said, this is the future. Here's what we do know though. Tech companies have been pouring money, obscene quantities of money, into data centers, into AI chips. NVIDIA's profits have nearly doubled because they are essentially selling the shovels in the gold rush. The entire build-out has been a historic wealth generator. But what's the return on the investment? The actual revenue from AI products reaching those consumers. The next 12 months will be the verdict. If public demand goes fast enough, it's a generational trade. If it plateaus or disappoints, well, have fun staying poor, because those positions are going to lose money quickly, precipitous. Now, this is probably the part that matters to most people watching this right now. The disconnect between the stock market and ordinary life is definitely not imaginary. It's not pessimism. It's just cold, brutal arithmetic. High energy prices from the war are hitting corporate bottom lines, but they're also taking approximately $4 billion a month out of the pockets of consumers, of people like me and you, not corporations, consumers, people. We should call them people, not consumers. Most Americans, most Brits, most people in the developed economies, according to current polling, are pessimistic about their prospects, about their future, about the economy. consumer confidence is tanking, and yet the market is still at all-time highs. That's not a paradox, that's the feature. That's the stock market being owned predominantly by the wealthy. The top 10% of Americans and Brits and Europeans own over 90% of the stocks. So when the stocks go up, the wealth gap doesn't just continue, it accelerates automatically, structurally. You don't have to believe in conspiracy theories to understand any of this. You don't have to believe in conspiracy theories to understand how systemic inequality actually feels. But if you don't believe me, for context, let's do something fun. Let's unleash a bit of dry wit, if I may be so bold. I do love historical context. The former shoe company, Allbirds, 2 weeks ago, announced they were pivoting to artificial intelligence, and their stock went up 700% overnight. A shoe company pivoted to AI, 700%. In 1999, a company called theglobe.com, they went public and rose 600% on the first day of trading. It was a social network. You've never heard of it because it doesn't exist anymore, and it didn't exist for a very long time. Now, I'm not saying NVIDIA is theglobe.com. I'm saying that when the shoe companies triple overnight because they typed artificial intelligence into a press release, we are in a particular type of market environment, and it's a fragile one. So, the one you've stayed for in this video, hopefully, is all about step 5. What you can actually do with all of this information. Option 1, ignore it. Feel vaguely anxious, let the market do whatever it wants to your financial future. Let your governments print ad infinitum. Let your wealth inequality increase ad nauseum. This is the most popular option. I understand it, because it's exhausting. But the option 2, start paying attention to the underlying earnings of these companies, not just the headline market number. 80% of S&P companies beat expectations this quarter, but 20% of them didn't. And those 20% were punished brutally. The market is not irrational. It's just not democratic. You can also just understand the difference between the stock market as a scoreboard and the stock market as a vehicle. The scoreboard tells us who's winning, and the vehicle lets you participate. The question is whether you're a passenger, a driver, or a pedestrian getting run over. The next 12 months will stress test that AI narrative. It won't reveal whether corporate profit margins are structural or temporary, but it will show something else, whether the oil crisis tips itself over into consumer confidence, and whether or not Deutsche Bank, their forecast of 17% gains in the S&P is in dreamland. Now, banks being optimistic is not the same as banks being right, but it does tell you the direction of where the money is going. So, to summarize, guys, everything is fine. No, it's not. The market is at all-time highs. Corporate profits are phenomenal. AI is transforming productivity. The banks are bullish, the hedge funds are bullish, the PE companies are bullish, 7 companies are making $500 billion, and you're standing still. Also, there's a war affecting global oil supplies. Inflation is back, baby, with a vengeance. Consumer confidence is collapsing. Don't let the metrics tell you any otherwise. A shoe company just became an AI company. The wealth gap is accelerating. The rich and the poor are ever diverging. And the entire bull run is concentrated in 7 stocks in one sector of one country. So yeah, everything is fine-ish for certain definitions of fine-ish, applied very selectively-ish. Look, here's the thing. The profit paradox isn't a conspiracy theory. It's a consequence. It's what happens when you design an economy that rewards capital and it concentrates power in a handful of vested interests. Now, understanding it by itself won't fix the problem, but it will mean you're not playing a game that you don't understand. And that, in 2026, in a world where a shoe company can become an AI company overnight, is not nothing. I'm Justin Banton. This has been your weekly reminder that the financial system is incredibly complex, occasionally absurd, and designed by people who went to better schools than you. Subscribe, leave a comment, tell me I'm wrong. I absolutely love that. Now, goodbye, my financially disobedient, quietly panicking, surprisingly now well-informed comrade. Ciao for now.